All right, we are getting going here, and we'll just wait for another minute or so until everyone's popped in. See a few there already, so welcome here. We're going to be working right away, getting started right away on understanding shareholder loans. So I will wait another 10 seconds, and then we are ready to begin. All right, awesome. Thanks everyone for joining us. Hope your audio is working and your visual is working and all that stuff. We are talking today about understanding shareholder loans. We titled this one "Take the Money and Run," and that's because that's what we see happen every now and then. So I am Everett Duerksen. With me here is Kaylin. She's helping me moderate on the back end, and so if there's any technical things, any issues we have to work through, she's going to help me out with that, and it'll all go super smooth. Thanks for joining us today. Let's dig right in because I want to respect your time and make sure you can get what you need out of this little session today. So first things first, intro and housekeeping. Obviously, welcome here. Happy to have you on board. Hope you get something out of this today for the few minutes we're going to spend together, or get a chance to ask some questions and things like that. So note that this will be recorded, this session. That makes it available afterwards as well, so that we can have others, or if you need to go back in and see something, you can do that as well. Your microphones are muted right now and your cameras are not on. So you can look however you want and say whatever you want, I suppose, in the background, and it doesn't bug me at all. It usually doesn't bother me anyway, actually, but just so you know, you have that privacy there and can just enjoy this wherever you're at. Later on, we will be doing a Q&A. And so if you want, there's a little Q&A button or tab at the bottom of your screen. Pop in there, ask a question, and we're going to get a chance. So at any time as we talk today, if you want to do that, go for it. It's a good chance for you to just kind of get some clarity about what we're talking about and what's going to happen. And then time-wise, the session's about 40 minutes, depending how wordy I get on a few things, where we're going to leave some time at the end for that Q&A, about 15 minutes. And so that's your chance to participate there and get some clarity. So we should be out of here by the end of the hour. Who is this for? I know we've got a few of you out there today that are on this list. We've got some bookkeepers that are watching today. That's great. Some business owners and entrepreneurs. That's who we work with the most. I also know that there's some lenders out there that are paying attention, and some advisors, consultants, and coaches. So welcome here. I'm glad you're here. I think this will apply to your clients for a bunch of those individuals and give you some understanding of what they face and some of their regular challenges. And then also it's for accounting teams. These are accounting concepts that bleed into tax and bleed into your personal life. And so there's lots there that you can then learn and then apply to the work that you're doing. Some of the situations you might be in, you might be starting a business and wanting to figure out what this is about. You might be confused about dividends and tax, which is kind of where the instance came from to put on this session. You might be in a financial planning situation and got to figure that out. You might be looking for a loan or just wanting to be proactive and most importantly, wanting to grow a healthy business. And that's what we help do as accountants here. We are looking for you to grow healthier businesses, and we love it when that can happen. So who do we have presenting today? There's my photo up on there. I am a CPA. I'm the CEO of our firm here as well, and a visionary. I do a lot of creation and facilitation, implementing a bunch of things in strategy. It's my role day to day. And then joining me for a little video segment is Brian Machacek. He's the tax and engagement partner here, a great resource for tax work, has done a ton of work with clients and saved buckets of money for people. Just great guy, is able to explain tax concepts to those of us who maybe are not wired naturally for that. So he's going to join us in a bit. Excited to have Brian on board, and that's what we're up to. Very briefly, what's our purpose? Our purpose, is really to keep you safe. We, not just in a compliance way, we want to help you plan into the future to keep you safe in the activities you do, sometimes protect you from yourself a little bit. We make things easy. That means we try to make it as seamless and easy as possible for clients to work with us and get information. And then lastly, we provide you with a plan. Our goal in growing healthy businesses is that they have a plan, and we work on that with our clients. So that's what we're about, very briefly. And let's get into the meat here right now. So take the money and run. Here's our objectives for today. First, we're going to start with some common language. We all know that when you visit a foreign place, don't know the language, tough to navigate around. And so my job today is to try to teach you just a couple of terms that you can use that you won't confuse with other ones. And they're very important ones. And so we're going to get to that in a minute. I want to show you understanding money in and money out. It's the way we view shareholder loans a little bit internally here. Then we're going to get into the tax pitfalls, and Brian's going to help us with that so that you can understand why this matters. I'm going to teach you the bucket and the hole, which is our way of describing this and maybe give you a visual of what's going on. And then we're going to wrap up with some tips, some must-dos if you're in business, especially as an entrepreneur or as a growing business. And then we'll wrap up and do our Q&A in that section as well. So glad you're here again. Let's dig in with the first one, which is what's our common language? Now, we hear it all in an accounting firm. I know you might not think that, but we hear things referred to as all sorts of stuff. We hear coffee shop talk. We hear my friend does this in their taxes, and so I want to do that as well. And often there's a confusion about what the language is. And so I'm going to start with these three words that commonly get misused. And I'm going to explain to you what they are and how they work. And the first one is dividends. Now, dividends are items that are money that is paid to a shareholder out of a company's profit. And I hear dividends come across as a whole bunch of different ways, but really what it is a company saying we have this equity and we're now going to pay a return on investment out to our shareholders, thanking them for investing with us. And this applies in large company, small company, very similar concept anyway. Some tax treatment is different, but it exists at all levels of corporate activity. The second one is draws. And draws often get confused with dividends. And really what a draw is just taking money from one place and putting it in another place. So taking money from an account into a different account. That's a draw, what we call a draw. And it relates to dividends, but it's not the exact same thing. So very important we understand what that means. And you're going to hear me refer to it again later on as well. And then the third one is wages. And wages are a thing that get paid to employees for labor, generally as an earned type of income. I do something for you, you pay me a wage. I come to work, you pay me a wage. I'm an employee of you, and you control what I do. You tell me what to do, and I go do that. And that's where I get a wage from. So three different words. These are all get interchanged in common talk, and they actually have a very different meaning individually. And how you're going to see these applied, and I'll show you this in a second, is you're going to see dividends are really an equity function. They reduce the equity of an entity down. They give you a return on investment. So they impact what's left inside of a corporation from investment purposes. Draws are mostly just a balance sheet account. They say we're taking money from here and putting it here. So it just moves money around really on the balance sheet. And create some problems, which we're gonna dig into also. And then wages are a profit and loss concept. They are generally a direct expense of the company. They might be in a cost of sales item, or they might be general in the operating costs. But what we need to understand is that wages are a thing that impact net income. They impact taxation at the corporate level. And so we want to treat each of these separately, know what they each mean, and it's going to influence the way we view this in general. So 3 words, that's our common language for today. You need to know those 3 things, and you'll hear me talk about them again as we go. So what are we going to look at first? Obviously, we should look at a financial statement. And half of you are rolling your eyes and saying, oh, Lord, I didn't sign up for that. And the other half are like, yeah, give me some more. And this is the only time you're going to see it. So just bear with me a second. This is a balance sheet of a fictional company that has some fictional, I can't remember which word it is, some type of word. This is not real numbers, is what I mean. And we're going to start with just identifying some key parts on the balance sheet. And the first one is assets. So on a balance sheet, we're going to talk about assets that are here. And this is very rudimentary. I apologize for those of you that have seen this a million times. Assets start at the top. Liabilities are next. That's the things we owe to other people, whoever that might be. And then the key one we want to focus on today, which is the shareholder loan. And you're going to see this called things like advances to shareholders, loans to shareholders, different things like that. But really what it represents is money that has interacted with the shareholder of a corporation. And it's got to live somewhere on the balance sheet. And that's what we see here right now. And that's what we're going to worry about as well. So that's what we're up to. Balance sheet is small, hard to read potentially here. That's fine. You're going to take a look at your own balance sheet after this if you have to, and find the shareholder loan account and just see if it shows up there. And if it doesn't, ask your accountant, do I have a shareholder loan of some kind? Where does it live? How does this work? So keep on moving from there. That's the last time you're going to see that. No more balance sheet. We're going to talk a little bit about money in and money out. And these are both critical because they each have a different impact on a shareholder loan type of transaction. So beginning with first, money in. I'm going to talk about it from the perspective of the corporation. So I'm a corporation, pretend, and money into me. So I need some money to operate. That's coming from my shareholder potentially. And so we're going to call that loan from a shareholder. And really this means I'm a company, I need some money. So I'm going to ask somebody else, my shareholders, to give me some money. Hey, can I borrow some money so that I can operate and do some things? That's money in. Money out is the opposite, where I'm actually going to spit some money out to my shareholders now. And so I have some as a corporation. Here's my money. I'm going to disperse it, get rid of it, do something with it. And we're going to call that, in this case, a loan to the shareholders, meaning I've borrowed them some money. So when a shareholder needs some money and it asks me to give them some, I'm going to do that. That's a loan to shareholders. So those are the two pieces, money in, money out, and they have a very different impact, which we're going to get into here now right away. So starting with money in, this is the loan from a shareholder. Now, why do I need money from my shareholder? Some of you know this already, and bear with me for a little bit. For a business to operate, I need some money. I need cash to do a bunch of different things. And where I'm going to get that from is a whole variety of places. I might get it from operating loans, term loans, which are typical types of banking or lending facilities. I may look to my working capital, accounts payable, accounts receivable, and juggle those a little bit to generate some cash for me. I might have a mortgage on my property. Maybe I own a building, something like that. I might have issued bonds to people, which are an interest-bearing type of loan that have a maturity date that they can call back. I might use leases for my equipment, some things like that. Or I might be issuing common shares or preferred shares. And those are really just the equity pieces that are going to generate some cash. And you'll see from small business to very large business, the range of tools used here is different, and no company is actually really exactly the same. A lot of them are different, although you can kind of group industries together with these types of ideas. And then the last one is a loan from a shareholder. And we call this whole arrangement the capital mix. This means I have a whole mixture of these items. How am I balancing those the right way? And we can even figure out, what's the cost of that capital to you, so you can evaluate, new projects. You can look at, okay, I'm going to build this new place. Here's going to be the cost of that, and here's the mix of how I'm going to get there. And it's something we work with a lot, mostly on a finance perspective. But that's your capital mix. The loan from my shareholder is part of that, and when I'm a small business, it's a key part. So let's walk through situation. I've got Beth's Auto Shop here. So there's Beth. She's got looks like a mid-80s hatchback that she's working on right now. It's her auto shop, wants to start up this organization or this entity, and knows she needs some money. So where is my money going to come from? And this is just kind of a standard example of how she might finance her business. The first is a building. She wants to have a building. You can see my little retail shop there. And she needs some money for that. She can probably go to the bank. A lot of lending institutions will give loans out on a secured property relatively easy, especially when it's being used in your business. So that's where she's going to look first for financing her new building. The second thing she needs is some tools. She's got to have some hoists. She's got to put together a toolbox full of all the goodies and the shiny things. And so likely she's going to look to maybe a lending institution, but maybe a leasing company. We see a lot of tools leased from time to time, and it makes it easy. It's quick transactions, and those leasing companies do that a lot. And then the third one is everything else. So all of a sudden, Beth goes, okay, I've got to hire people. I'm going to need some computers and some systems. I need to pay the power bill. I need some technology in here in the shop for diagnostics. I need to keep the business just going, and I need some money for a rainy day. And the question is, who's going to finance that? Generally, it's nobody. Nobody wants to because there's no security there. They don't know whether it's going to be successful. And so it takes a couple of years for Beth to actually get some feet under her to be able for anybody to actually want to look at that. And so she has this question mark, where will I find the money? And in comes the shareholder loan. And here's where she decides, okay, great. I need some money. I'm going to go source it myself and bring it in. So where does Beth get that cash from? Most shareholders we see pull it from a number of different spots, and I'll walk you through three of them. Those loans come from either past savings, maybe things she's done in the past, other businesses, might be from an inheritance, might be from a reality TV show. I don't know if you watch some of the baking championships, but you hear them talk about, when I win this 10 grand, I'm going to start my own bakery. And so there's this sense of this money would give me that leg up to be able to start my own business. And anyway, you might not be on the baking championship, but it is it's an idea that that money has to come from somewhere. So past things that they've done, maybe past employment, whatever. Second one is typically their personal lending. So some people will pull money from their HELOC, which is an equity line of credit against their house that they own personally. And so most of us, many people have a personal mortgage. We own a house, but we often say that the bank owns more of it. Well, that's fine. This is your mortgage. And if you have it in the type of facility that you can take money out, you could actually use it in this sense inside of your company for a shareholder loan. And then the third one is just the goodwill of other people. How many friends do you have and how much money do they have? So you might be willing to go out to them and they might be ready to help you depending on how good your idea is. And you want to be a little bit careful maybe when you're financing things with your friends. It's a good way to be friends, but when it falls apart, it's a good way to end that friendship. So if that's what you're out for, then go for it. If you're not out for that, then just structure it nicely and we can help you with that as well, so you don't get in trouble and that it doesn't ruin an otherwise healthy relationship. And then really, how does this work? So Beth is going to transfer some money into her company bank account. The bank, the company is going to use that money to do its operations, all those things I talked about, the power bill, the utilities, the cleaning, the uniforms, all that stuff. The company is actually going to keep track, right? As Beth puts in cash, company is recording this. Okay, this happened. And then it might decide to pay interest to that shareholder. So Beth might say, you know what, because I'm borrowing you this money, I actually want some interest back because I could get some interest somewhere else for that same money. And it's not a requirement. You don't have to do that in most cases, but often we see it. And that makes so that you file a T5 at the end of the year. So another thing for you to report, which says, hey, a T5 says, hey, we earned some income as an individual, and this is where it came from. And then as the company gets some cash down the road, it's going to pay it back. So when the company is doing well, Beth's shop is profitable, she's generating some income. She says, great, I'm going to start dipping into this money that I loaned and actually going to pull it back out. And you might see this happen over and over again. Next time she wants to grow, she needs some more cash, she does the same thing. Next time she wants to add a hoist or a bay, does the same thing. So pretty common, we see that happen over and over again. So that is money in. Next piece is money out. That's the natural flip side of it. And we're going to call this the draw. And so that was one of our three words at the beginning, draws. This is the draw. So we know that as individuals, for us to live, we need money from somewhere. And with small business in particular, a lot of times we see that money coming directly from their corporation, their company, their business is funding their personal lifestyle. And this might be in a number of ways. It might be in wages. There's that term again, wages for labor. Interest on the money they've loaned, dividends from somewhere. People might want to sell things if they need some money. They might be able to borrow from banks, borrow from others. You don't want to borrow from too many people, probably. You can get in trouble with that. And then there's borrowing from their own company, which is what we're really focused on here today. And that is the risky side of this. It makes it easy to do, but it also has some repercussions. So that's money out. And where does that money come from? Well, these are kind of no-brainers a little bit. Your money is corporate money, company, business money. It's coming from what it's saved in operations, just running its business, right? And that's pretty normal. We see cash build up from that. It might come from bank debt. I know that all the bankers or lenders on the call will not like when I say that, but let's say you go borrow some money in your company, and now you have some cash against a property, and you use it to pay out your own loan. And there's sometimes some restrictions on that the bank will give you to say, hey, no, you can't do that. We don't like it. And so you'll see some of those terms in the agreements you have. That's pretty normal. It's their way of protecting themselves as well, so that you don't just go to town on their new financing. And then they just might find it from other debts. So you might get loans from other individuals. We see a lot of private loans. There are sometimes can be RSP loans, a bunch of different things like that. And it depends on the situation. That gets really complicated potentially. So we're not going to dig into that today, but this is where the cash comes from. And how does it work company to individually? Well, here's what happens most often. The company says, we're just going to transfer some money over to you as an individual from our bank account to your bank account. And that is, really that transfer is a draw, like we talked about. And that's one of the ways it happens. The second way that it happens a lot is the business pays for some of my personal expenses. So I just run things through the credit card, the corporate one, whether it's for my groceries, whether it's for whatever. And we call that a type of draw as well, because really the company is financing my personal lifestyle. And there's a lot of intermingling that happens there. We know that. I'm not going to dig into that today, but it exists and we do track it. As an individual, we often don't keep track of how much we've pulled. And this is, I think, maybe one of the biggest takeaways of this, if you're listening, is pay attention to that. And I'm going to say it again a little bit later, but don't just borrow from your company like it has an endless supply of money. You're going to need to reconcile that later. And so, if you don't keep track of how much, you need to start. Sometimes you don't pay interest back to the company, and obviously that's the case. A lot of shareholders don't pay interest from themselves to their corporation, and that's pretty normal. There were some funny loans years ago you could do, but we don't recommend it a lot. Often the accountant is the one telling you how much you took, and so you go to them at the end of the year and they say, oh, this is how much you drew out, and then your jaw hits the floor, and then you deal with the consequences later. But either way, somehow you have to pay back the money to your corporation. You can't just borrow it indefinitely. And often what we see here is the rinse and repeat of this activity, and people get frustrated by it. And that's what we're here to solve today. Reduce that frustration, make it go away by giving you some ideas about how not to do that. Let's draw it out. Here's the visual example for you. Beth, our illustrious shop owner, she needs some money. And so she goes, hey, my auto shop has been doing well. We've got some profit. They've got some money. So I'm going to draw that money out. There's that word again. I draw some funds from my company. And then I do it again. And she does it again. And she does it again. And just over and over, month in, month out, she keeps pulling this money out. And all of a sudden, we get to her fiscal year end. And she goes, great, here's my year end. And she goes to this person, the dreaded accountant. And she says, hey, here's my stuff. And the accountant goes, oh, we got to fix a whole bunch of things. And here's what we're going to try to protect you from today is having that feeling of the dreaded accountant when you go to the year end. And the reason why it's dreaded is because the accountant must do something. They're your advisor. And so there's a couple of things they have to do. One, they have to see this from an equity perspective, meaning have you drawn out way too much to support your enterprise and your growth. But also there's significant tax issues here. So there's some sections in the Income Tax Act, one in particular, Section 15, that says you can't borrow money from your company for very long, or else. And there's some caveats into there, but CRA knows, and the regulations know, hey, this isn't good. And there's reasons for that. Mostly it's because of integration of tax rates, but I'm not going to talk about that. You can call Brian sometime and ask him about that. He loves to talk integration. But the real idea is here, you can't do it, and you're going to get in trouble for it somewhere down the road in some way. So our job as accountants is to protect you from that trouble. And really the idea is that no matter what, you will pay some tax. Now, we do try to minimize it whenever we can. That is a part of our role, part of our job for you, in keeping you safe, is to minimize the tax that you do pay. But just so that you know, you can't just take the money and run and get away scot-free. You got to deal with it somehow. And so we're going to work on that. So let's take a second. I want you to hear from Brian on this. He's got a short video clip here. You might just need to adjust your volume as it happens, but let's walk through it and see what he has to say about the tax side of this.
Hey everyone, it's Brian Machacek here with a video regarding shareholder loans, specifically the tax implications thereon. Like everything in tax, the devil is in the details. So we could be spending hours and hours talking about the intricate tax rules regarding shareholder loans, court cases, things of that nature, where taxpayers have been fighting with Revenue Canada. We're not here to do that. Really, we're here to discuss just the high level rules, and that basically say in a nutshell that if I remove funds out of my company and I don't repay that by the following tax year of the year I took it, I got an income inclusion. So you might be removing funds out of your company through wages and doing payroll remittances and a T4 on your personal return. That's not what we're talking about. You might be doing a regular quarterly dividend out of your company, removing the cash, preparing a T5 at the end of the year, T5 on your personal tax return. It's not really what we're talking about if that is a regular thing that you do. What we're talking about is that when we're dipping into the corporation bank account, to pay for expenses, personal expenses. Maybe we need 10 grand to make them, our personal property taxes, our home property tax payment. Maybe we need, or we want to buy a new vehicle personally, and money's in a company bank account. I'll just pay for it that way. If we're doing things like that, or even just small little expenses like the routine day-to-day stuff, personal charges, those all accumulate over time, and they have to be dealt with. When I'm indebted to a corporation as a shareholder, I have one taxation year after the year I become indebted to repay it, either in cash or in some other form, which typically takes the form of an extra dividend declaration and some more T5 dividend income on my personal tax return. So yeah, when we extract funds from a corporation or extract property from our corporation that we're not dealing with in our regular remuneration, we're going to have tax implications, and I don't have a lot of time to deal with that. And that's really the key. Know where your shareholder loan is at all times. How does it feed into your regular remuneration plan? And if it doesn't, you're going to have tax implications, and those tax implications are on the near horizon. Okay, hopefully this helped out and helped you understand some of the tax implications in behind shareholder loans. See you around.
Right on. So there you have it from Brian's mouth, the years of wisdom he's got there. We want to be careful with this, and we're going to look at how to here right away. This is the common phrase I hear all the time. Hey, Everett, but Everett, there's no way I took that much money out. And I could count if I had nickels for all the times I've heard it. And my answer is always, I'll show you, here it is. And what I don't want is for that to be a surprise for you. So we work hard to make that a preemptive discussion rather than an after the fact, because after the fact leaves us with just very few options. So thanks for Brian for putting that together. He's got lots more to say about that. He could talk about it for a really long time and is great at that. But I want to walk you through a bit of a visual that I put together called the bucket and the hole. And this is a way we've used to describe this activity in the past. Gives you a bit of a different way to view it, and maybe it helps you understand a bit more. So let me just start this here and take a listen to how this applies in the bucket and the hole.
Here's the concept I call the bucket and the hole. Let's pretend you have the first scenario where we're borrowing money from a shareholder to a corporation. What you'll find is that we're going to refer to that as the bucket. So as a shareholder, you put money into your company little by little. Here's where we're adding some funds because we need it inside the company to operate. And so we're filling up our bucket in the meantime. At some point down the road, when the company has enough money to pay back the shareholder, we simply just empty the bucket and pay back the money. Now the shareholder has their funds returned and the company can continue to operate. If in the future the shareholder needs to put more money back in, they simply do so and they repeat it. The alternative, though, to that is when the company is borrowing money to the shareholder. That's not a bucket. What they are doing is digging a hole. So as you draw money out of your company, and here's where we look at the word draw, which we touched on earlier. Every time you draw money, you take money out of the ground and you create a hole. So here I take 5,000, 10,000. Here I buy something. Here I buy some gifts. Here I take some more money. Here I pay some personal expenses, and so on and so forth. And as I do that, I am digging a hole. When I get to the accountant at the end of the year, they're going to say, "Good sir, you just dug a hole all year long. We need to find a way to put that dirt back in or fill in that hole." And now how do we do that? Well, if I have the money, I guess I could put it back into the company to replace it. But often I don't. And so what they do is they say, well, let's declare a dividend. So the example would be, I take $50,000 over the course of a year in various formats. That's my hole. What my accountant will do is say, let's do a dividend for $50,000. And the reason why is because that fills in my hole. Now it's gone, and I'm back to square one. Many people do this over and over again each year, digging a hole, filling it back in, digging a hole, filling it back in. The problem comes when I actually dig that hole a little too deep, and this 50,000 is more than the equity left in the company. Because what a dividend does is it says, hey, company has some equity, let's take it and give it back out to the shareholder. That way they can fill in their hole. That's not necessarily great for business, because I'm bleeding my company dry of any of the equity I earn. What I want to be doing is increasing it, building it up for future use. That is my analogy of the bucket and the hole.
There you go. Yes, sparkly money is the best kind. You should always want that kind of money, not the boring old regular money. That's why in Canada we have so many colors of money, I think is because we're creative and we like sparkly money. So that's the bucket and the hole. Tips for your business. Here's what we're going to get into. Here's kind of the meat of all of this. You know now what we're talking about. You've seen some example of how it works. What do we need to do to pay attention to this? And the first one from my perspective is to have real-time data. Knowing your numbers just once a year is not going to cut it when it comes to a shareholder loan, because it will be a surprise to you every time, I guarantee. So we always encourage real-time data. That means you know the numbers all the time. And that's the way it works. So first thing, real-time data. The second one is know your loan balance always. If you are a shareholder, it's your job to know how much the company owes you or you owe the company. Either your bucket is full or your hole is getting dug. Either way, you want to know what it is. That's an investment you have. So if you're a shareholder, that's what you need to know. If you're a bookkeeper, that's what you need to be telling your shareholders. This is your balance. This is where you are, because they need to be able to predict that down the road. And if you're a consultant, you need to keep your eyes on this, or a coach, and pay attention to where is the capital coming from? What's that mix look like? And where is this loan at? The third thing to do, this is a great tip, plan your dividends in advance. And I know that's not always possible. There are situations where it doesn't work, but we work really hard to plan before the year end for sure. Sometimes even at the beginning of a year, hey, this is what we anticipate for dividends this year. And that is going to help you as a shareholder incredibly. A, it helps you plan your cash flow for both entities. B, it helps you know what your income is going to be like. We can do installments, all sorts of things. Don't plan your dividends after the fact if you don't have to. It's not ideal. You're going to be a little bit hamstrung with what you can do. Fourth one is pay yourself a wage for what you're worth. Dividends has been used as a remuneration strategy, like Brian talked about in his video, and it's been done for a long time. And the only reason it's been done that way is because CRA allows it and the tax system allows it. But from a business perspective, it's not actually the best way to run your business, meaning that dividend, you remember I showed it as a balance sheet item or an equity item, it's not hitting your profit and loss at all. And so in a normal business where Beth is working hard, but not getting paid any wages, you're actually not going to see the cost of her on that profit and loss anywhere. And so you're kind of misleading the business in terms of whether it's making any money or not. It's going to be tricky. So pay yourself a wage for what you're worth. It'll help you identify whether your business is doing well or not. And as well, it will help you figure out when you can migrate out of the business and have somebody else take your place so that you can keep growing and be entrepreneurial inside of it. That's a key one. The fifth one is pay interest on those loans. It is a cost of business to borrow money, and we know that. And so I want you to treat your loans into the company the same way you would treat the bank, pay them their interest. It's a bit of that return on having capital invested, and it will also help you recognize your capital mix a little bit as well and figure that out over time. The next one is plan tax installments early in the year. This goes for both corporations and individuals. And typically when we have owner managers of businesses that do this dividend, they dig the hole right over and over again, shovel, shovel. They get to the end and they haven't planned what the taxes are going to be. And that happens a lot, and it's often a surprise, and we hate it. We hate it as accountants, and typically the shareholders don't like it either because they didn't want that. And so all these things coupled together are going to give you that ability. And then watch your bucket and watch your hole. Just pay attention to it, know what's there, and know what you need to do with it. And that sometimes will include having an annual plan. And this is where some of that planning in advance comes. We work together with you, and we want you to know what's going to happen all year long. When we can, that's our goal. Doesn't always work, but we sure love to. So how do we do this in a healthy, growing business? First of all, I want to say that your bank and lender or lender will care about your shareholder loan balances. So I did talk to a couple of my friends who are in the lending industry, and I heard some of the same things. Yeah, it matters to us. We want to know what the shareholder has invested in. We want to know when they're drawing too much out because it's going to put our money at risk. And so I appreciate them contributing that comment to me as well. But they do care. So have the conversation with them. You need to understand your ratios and know how to calculate them, because they're also going to ask you about those. And you should have them in a bit of your back pocket. Only a couple is what you need, 2 or 3 to know what really drives your business. Find the correct capital mix. That means working capital, debt, equity, whatever else. Figure out what works best for you, especially in planning, 12 months ahead. What am I going to need to grow this business? What kind of capital? And then my next point I love is spending like a drunken sailor. Don't do that. We see a lot of new business owners start up a company. They're all happy and proud, and I get that. I appreciate it. But don't just use the new money like it's going out of style. You just pulled into port and there's a lot of rum available. That's not what you're up to here. You're about growing a healthy business and not dealing with that. And so then create an annual plan and follow an annual plan. That is ultra critical. You got to have a plan when you're in business. That's what your coach is going to help you with, an advisor. That's what your accountant's going to help you with. All those working together are going to give you a great plan. And here's how we do that. We have a thing we call the 365 total care. It's not a thing, it's a strategy we use with our clients, with all of them, where we will be in a meeting with your banker, get on a call with them. We look at your ratios a lot during the year. We tailor our financial statements to what you're doing. We look at your current ratios, some of your capital targets when we can, when you know them, and we can work on that. We look at some debt to equity targets, which is also a ratio. We watch the books, which means we're in there keeping an eye on what's happening. We have a product we call the strategic improvement map, which means we're going to get together and really strategically look at your improvement and how we're going to work together to get there. And then a quarterly check-in that we use in our 365. It keeps you up to date. Sometimes it's a bit of a fess up and check-in type of event because you haven't done what you said you were going to do. And we want to be able to help you do that, just like your coach would, just like an advisor would as well. So rely on them if you've got one of those for keeping you accountable to move along your plan. And that's kind of it. Those are the big pieces. I want to say thanks, first of all, Brian, thanks for the commentary in the chat that I clicked on one time and I shouldn't have. That's awesome. You being here means you're working towards a better business, either for you or for others, and we appreciate that. So if you do have questions or concerns, anything else that you're actually interested in, we're going to do some more of these this year. Just email us, connect@ejdworks.ca, or reach out to Caitlin or I as well. We're happy to be here. We're happy to help build healthy businesses with you, with our friends, with our clients, and whoever's out there. And that is the fun that we get to have every day. So a lot there about shareholder loans. Hopefully Beth is going to be fine with her auto shop, and now that she's got some new advice to work with. Here's the chance for you to be able to work through some questions, and I'll try my best to answer them. I'm not an expert at all things, and if we do, we'll follow up later. And if we can't get to you, we'll follow up as well in the future, because this opens up a whole bunch of conversations, and some of them are just too long for what we can do today. So use the Q&A function or the button, ask a question. I'm going to invite Caitlin back to the conversation, and she's going to help me moderate through a little bit, and we'll answer them and see what we can come up with here before our time is up. So Caitlin, we're right on time, I think. What have we got to work through?
Yeah, no, absolutely. We did really good. It looks here like I have one question, which asks, I believe, if I'm putting this right, recommend owners work with a certified bookkeeper. So I'm not sure if that's asking if you recommend that owners work with a certified bookkeeper, like what's your position, what's your stance on that?
Yeah, right on. Why there's a statement or a question, I'm totally fine with that. The point about bookkeeping is a super critical one for business owners, especially entrepreneurs. If you want to have a growing business, you need to have a bookkeeper who understands what that actually means, and is not just using your bookkeeping data for the account at the end of the year. That's great. I feel privileged when someone brings me their shoebox full of things to say, here's my data, here's the year. I have no idea how it went. I didn't look at it all year long, but here it is. You know what? That is probably part of the evolution, but our goal is that you're not there. And so you need to find a bookkeeper. If it's yourself, great. If it's somebody you hire, that's a certified bookkeeper. There's a few organizations in Canada that have bookkeeper certification and things like that. And I think there's value there. The real key is find the one that's going to keep you up to date with that real-time data. That might mean you're living in the cloud with some things, and you got to think that way. I mean, we've been doing that stuff for 10 years now. It's time for the world to be living in that real-time world, especially with your data. And this is your money we're talking about. So don't leave it just to chance. Have a bookkeeper who's willing to do that and follow up with you and keep you accountable as well. Show you those loan balances, things like that. Yeah, thanks for that question. I totally agree. It's critical. Your data is better than just for once a year. It's for all year long. Yeah.
Yeah,
Love it.
no, absolutely. I have another question here. You indicated I should plan dividends in advance. How do I do this if I don't know what will happen in my business this year?
Yeah, well, this last year, Caitlin, was a great example of that. Um, and even though things can go off the rails for us in an economy and in some businesses, that doesn't mean we avoid planning. And so if you're in business, especially if you're in a growing business, we know that cash flow is the king of the world. If you don't have cash, you're either out of business or you're really struggling. And it's tough to go find cash quickly sometimes, especially inexpensive cash. So what we try to do is plan your dividends by saying at the beginning of the year, Brian referred to it as well, hey, how much do you think you're going to need to take this year? What does that look like? So what we do internally here, we have a tool we call a remuneration strategy. And what we do with that tool is really plan in advance. We say, what are you going to need money for down the road? Are you going to be borrowing in the next little while for a house? How much are you going to have to take out? What does your family income need to be? A whole bunch of those things. And so even though it's going to be difficult to plan that in advance, sometimes you're still going to want to do it. It's sort of like a budget. Hey, this is going to keep me on track. And what it will actually do, if you can apply this well, is it will determine how much you spend personally. So if you know you're getting this much money every month, you will only spend hopefully up to that much, maybe a little bit less, and it helps you plan your savings, your giving, all those different things. So planning dividends in advance, I think is super valuable. Even if you get it a little bit wrong, at least you've done the plan and you can keep predicting and get better at it year after year. So yeah, great question.
Perfect, perfect. We have another question that just came in. Where did you get the strategy boards?
that must be it must be in the background here. That's top secret. You'll have to connect with me separately to get that. We got it with a group that we work with. And we use it a little bit for understanding how business flows and being able to walk clients through that as well. So I love it. I love inquisitive people who are paying attention behind me. You should. The other one though as well is a painting we got in Haiti, up in Port-au-Prince. And so both have meaning to me in very different ways. But the strategy board is one that we refer to a little bit internally here, and we should, Caitlin, we should probably make a copy that we can share with our friends, so that they can have strategy as well. Strategies that the business relies on. It. You need strategy in everything. So yeah, awesome.
Absolutely.
Yeah.
We're on it. We'll get it done by the end of this week and we'll have it out. All right. So I have another question here. How are dividends taxed differently to me than wages as a shareholder?
Yeah, you know what? That is a very key question here. And that goes back to our common language, right? We had three words. Wages was one of them, dividends was one of them. And this is why it makes it so easy to get in trouble with your personal income. So dividends first, you've got to think of them as an after-tax event at the business level. So the business is going to earn some money, pay some bills all the way down and pay some tax. And then we have this number that is net income. And it's a number we look at quite a bit. But dividends is nowhere in that list. It actually happens after that when the company says, okay, great, we earned this net income. Now let's pay out a dividend. And so that's why it's a piece of the equity. It has nothing to do with the profit and loss. So when that dividend goes out, it actually happens at a lower tax level to the person because the company's already paid a bit of tax on that whole chunk of stuff that happened. So we like dividends as individuals because they're a way lower tax rate than a wage is. And so compare that to the wage over here. A wage is part of that whole calculation. So a company earns $100, pays out some costs, some things, and then it pays me a wage. And that is a direct expense to the company, meaning the company pays effectively no tax on that number. It's an offset, it's a deduction. But then as personally, I'm going to get it at whatever rate I'm in, but it's way higher than the dividend is at. And so the two really have to do with when was the tax paid? And that's a little bit of that integration thing I referred to, the piece that Brian loves to talk about as well. That integration is super critical to you planning your corporate activity and your tax rates in particular. Yeah, so I love that one. It's a good one.
Perfect, perfect. Okay, I got another one here for you, Everett. What do I do if I don't agree with what my accountant has said my shareholder loan balance is?
Yeah, just take the money and run, Caitlin. It's you know what, that is the struggle. I would suggest you get on a rhythm of knowing your shareholder loan balance, like we kind of said in the tips and the must do. That's the critical piece, because sometimes the accountant doesn't actually know what's gone through that account all year long. They might just see the end balance and say, we've got to do something with this. They're not, in most cases, they're actually not auditing the whole thing. They're not looking through each transaction to make sure you took that, to vouch it back to your personal bank account, things like that. That you're not paying them enough to do that, first of all. But they're not interested in that. They're there to fix the problem of the hole that you dug. So this is where shareholders and bookkeepers need to be, vitally aware all the time. This is my balance, and keep an eye on that account. So I would say, if you're in that spot, you got to print out your shareholder loan ledger for the year. And I know this sounds tedious and boring to most people, but you just got to go through it. Yes, I took that money. Yes, 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 yes. Oh yeah, I bought that boat. Oh yeah, I did that trip. And what you'll do is you'll be able to find those areas where you're sort of bleeding the money out, kind of subconsciously sometimes, because we tend to forget about that stuff. Often with your accountant, you're sitting there, potentially 14, 16 months after you actually did the transaction. And we also are terrible at remembering that stuff, right? Like, I can't remember that far back, Caitlin. So that's why the real-time updates, looking at this monthly, quarterly at least, is necessary, because you'll know in your head, oh yeah, this is what I did. Oh yeah, I took that money. And so if you disagree with your accountant, that's what you got to do. That's the step. And then you got to be able to show them, here, sir or ma'am, here's my shareholder loan, and I know that it's good, and I'll pay the consequences or whatever that might be. So yeah, love it.
Perfect, perfect. Another question just came in here. Can you comment on any advantage to taking wages up to the max of CPP deduction and then balance of needs taken as dividends? Is that a good plan?
Yep. To quote Brian Machacek, in taxation, it always depends. And that's a terrible answer for something like this, but it is the right one. The answer is it depends on what that shareholder really wants to accomplish with their remuneration strategy. So you're going to see some people want to have CPP. And that means they want to get paid out CPP down the road as well when they're ready to retire. So in Canada, that kicks in, between 60 and 70, and you can find a spot in there. And there's a whole bunch of math that happens in behind the scenes, and we sometimes leave that to the financial planners, because in the end, some of it is a guessing game. You're guessing how long you're going to live. You're guessing at a bunch of different things. But the idea there is that you're putting money away for a pensionable thing that you're going to recover down the road. So is it a good strategy? It can be a very good strategy. You might also want to consider the RSP threshold that the person has. So your RSP contribution room bumps up every year based on your wages. It's all an earned income item, not a dividend. Dividends and interest don't impact your RSP room at all. So if you have a shareholder or a company you're working with, doing the bookkeeping for, and they say, yeah, I want to contribute max to my RSPs, you're going to want to take their wage actually up higher to where that I think it's 18% is pumping in there every year so they can keep contributing. So the question, taking wage up to the CPP threshold, then taking a dividend on top of that, it can work very well. One of the things it doesn't reflect very well is the true cost of that person in the business. So if you think about it from a pure management accounting perspective, just going wage up to the CPP probably isn't going to capture what that person is really costing the business all year long. So if you're concerned about that analysis, which we tend to be, I do a fair bit of management accounting rather than specific taxation accounting. And that's one of the things we look at. What's the true cost of this machine or this resource or whatever it is? The question's good. I can't say yes or no because it's individual. The response depends on the person, depends on the company, depends on your future plans, a bunch of good things. So good question. But consider all those other things as well, all the way up, trying to think even, there's lots of times when we're planning income, we look at, in Canada, we have so many benefit things like child benefit has an impact on how much you take out. There's just a myriad of planning. It's sometimes hard to do because so many variables that could be situations really. Yeah. So thank you for that question.
Perfect. So just looking at time here, it looks like we have a couple more minutes for a couple more questions here, Everett. My accountant has never asked for real-time data. Can you describe why that is important?
Yeah, I mean, I've mentioned that now a couple times today, and I think where I want to clarify is that your accountant, depending on the style of accountant that they either care or they don't care. Meaning they're leaving. Some will just, the traditional accounting model is to leave you run your business all year long. They'll phone them if you have any questions or get in something where you need something extra, and then we'll deal with everything at the year end. And in that kind of situation, it's not actually valuable to them. They're not going to look at it. They don't need it. So why would they suggest it? We follow a bit of a different model, I admit, Caitlin, where we want to pay attention to our clients all year long, and we actually do. We watch what they're doing. We work with them a couple times a month on various things. We're paying attention to what taxation is doing. And where it applies to our clients. And this last year was a perfect example of that with the subsidies that came out. And if you're watching this video later, we're talking about 2020. You needed to be real time to figure out how much you were going to get from some of these things. And so we spent a lot of time with the clients, and the clients that had that stuff up to date, that claim was way easier to make than the ones we had to fish through a bunch of information, try to put it together after the fact and figure it out. So real-time data is great for you if you're in a healthy growing business. From a plugging perspective, we work with our clients all the time, and we need their data to be real time because that's the only way I can give the best advice. As a bookkeeper, that's the only way you can give the best advice. As a coach as well, seeing the real numbers and making sure they match up in a bunch of ways. Anybody in that sphere is going to want it. So the reasons for not doing it, in my mind, are few and far between. So yeah, I might have an opinion, Caitlin. I'm just going to say that might be it.
No worries. All right. So just the final question here, Everett, of the day. Yeah. We only do our bookkeeping every 3 months or so. How do you recommend we adjust so we can see our shareholder loan account more consistently?
Yeah, I believe the move is there away from paperwork in particular. The programs and the apps are out there and are linked with the software. There's tons of integration. We can help you. We can point you to companies, businesses too, that work with others in integrating the pieces the right way. There's not much of a reason anymore to run on a quarterly type of bookkeeping environment because you can do so many things in soft copy with the cloud all the time, day in and day out. So, the simplest form is the receipt bank, or it's called Dex now, that type of model where you take a photo of your receipt and it hits the cloud and it's stored there and it hits your QBO at the same time. And that is moving you into that rhythm, that pulse of daily activity, where maybe quarterly you're reconciling some things or at least just issuing financial statements. But the move is far removed from doing quarterly activity anymore. You need to have your bookkeeping engaged, I think, all the time, whether it be in that soft way. And for bookkeepers, that's a shift too. They've got to be willing to not get stuck on doing the old way of doing things, right? To move from I'm going to do this based on the paper you give me. That is slowly dying. And so you got to consider that too in your business. Are your clients ready to do that? How are you going to coach them along that way? Be involved with them more often. And they're going to find greater value from you, first of all, because you're part of their business now. You're not just the one that does some admin on every 3 months with the shoebox. And that's the classic story. And it's probably never too old to talk about. So Yeah, anyway, that's my short answer to that question.
No worries, no worries. Yeah, there's a comment here that just says proactive bookkeeping with a bunch of key points on there going, yeah, let's do this.
Smiley face, exclamation mark. That's
Yeah.
running a business. Look, if you're running a growing business and you want it to be healthy, you have to have it. You have to have proactive bookkeeping, proactive accounting, and a team of people that are going to help you out. And that's just all there is to it. You will lag behind and struggle if you never commit to that concept. It's tough to say, but it's true.
Perfect. No, that's great.
Right
That's
on.
all I have for you now, Everett.
Okay. That's awesome. Well, we hit our mark there. It took a minute longer, so I cut into somebody's next meeting or lunch by a minute and a half. But I certainly want to say thanks to everyone for joining us. This has been great for me to talk through. Like we said, if you have things you want to hear from us about in terms of future webinars, happy to do it from an accountant's perspective. I'm also an entrepreneur, and so I know the feelings that a lot of you have, and we can work through those together. But this is great. So leave those in the comments, send us a note at that connect@ejdworks.ca, or just reach out to us. We're all over social media, so there's no stone left unturned. And yeah, thanks everyone for joining us. Is that it, Caitlin? Are we good?
Yeah, we're good. We just had one more comment come in saying, thank you, great information and session, would love to recommend clients. So yeah, thank you. That's awesome.
Awesome. Yeah, appreciate your time. We'll see you again with some more, and have a great rest of your day.